Hey everyone, and welcome back to the channel. Today, we're tackling a question that's probably on a lot of your minds. We've all seen the headlines. Mortgage rates are finally starting to come down from those dizzying highs. Logically, that should mean buying a home is getting easier, right? But for so many people, it feels like the complete opposite. It feels like the housing market is actually getting worse, more competitive, and more frustrating than ever. So what is going on? Is it just a feeling? Or is there something real happening under the surface? In this video, we're going to dive deep and unpack the paradox of falling rates and a worsening housing market. We'll look at the key factors at play, from inventory levels to buyer psychology, and explain why this counterintuitive situation is our current reality. Stick around, because if you're trying to make sense of this market, you need to understand these dynamics. So let's start with the big one, inventory, or more accurately, the severe lack of it. You see, when mortgage rates were soaring, a lot of potential sellers decided to stay put. Why would they? Many of them are sitting on mortgages with incredible rates, like 2, 3, or 4%. They're locked into a great deal. If they were to sell their current home, they have to buy a new one and take on a new mortgage at a much higher rate, even with the recent dip. This is what economists call the lock-in effect. It essentially freezes a huge chunk of the housing supply. Homeowners who would normally be upgrading, downsizing, or relocating are choosing to renovate or just wait it out instead. This creates a massive supply shortage. So even as rates fall and more buyers get encouraged to enter the market, they're all competing for a tiny, tiny pool of available homes. It's like a game of musical chairs where the music just got a little better, but half the chairs were removed. More people are joining the game, but the chances of finding a seat, or in this case, a house, have actually gone down. Now, let's talk about the demand side of the equation. The recent drop in mortgage rates, even if it's slight, acts like a green light for a whole group of buyers who were previously sidelined. Think about it. For months, people have been waiting, watching, and hoping for a break. The moment rates dip below a certain psychological threshold, say from 7.5% to under 7%, it triggers a wave of activity. Buyers who were priced out suddenly see a glimmer of hope. Their potential monthly payment might now just barely fit into their budget. This sudden influx of demand, crashing into that critically low supply we just discussed, is a recipe for chaos. It creates intense bidding wars, offers going way over the asking price, and a return to the frantic market conditions we saw a couple of years ago. So, while a lower rate is technically better for your wallet on paper, it also means you're now competing with 10 other families who had the exact same idea at the exact same time. This competition is what makes the market feel so much more aggressive and, frankly, worse than when rates were higher and the market was quieter. Another huge factor that often gets overlooked is home prices themselves. Hear it. The painful truth. Home prices never really corrected in a meaningful way in most areas. While the rate hikes did slow down the pace of price growth, they didn't cause a crash. Prices largely held firm or only dipped slightly before starting to climb again. So we're in this strange situation where we have slightly lower mortgage rates, but they're being applied to home prices that are still at or near record highs. A small reduction in your interest rate does not do much to offset a home price that has ballooned by 40% over the last few years. The overall cost of home ownership remains incredibly high. The affordability crisis isn't just about the interest rate. It's about the combination of the price of the asset and the cost to borrow money for it. So, even with a rate of 6.8% instead of 7.5%, the monthly payment on a median-priced home today can still be significantly higher than it was just a few years ago when prices were lower, making it feel like you're running in place or even going backward. Let's also consider the psychological aspect of the market. The last few years have been a complete roller coaster for home buyers. There's a palpable sense of fatigue and desperation. Buyers have been through the ringer, losing out on multiple offers, seeing prices skyrocket, and feeling like their dream of home ownership is slipping away. This emotional toll can't be underestimated. When rates drop and the market heats up again, it can feel like another round of a game you're already tired of playing. The renewed competition brings back all that stress and anxiety. Furthermore, there's a phenomenon known as FOMO, or the fear of missing out. When buyers see the market picking up speed again, they worry that if they don't buy now, both prices and rates will just go up again, and they'll be locked out forever. This fear drives people to make rushed decisions, waive important contingencies like inspections, and bid more than they're truly comfortable with. This high-pressure environment is what makes the experience feel so negative and stressful, regardless of what the interest rate number on the screen says. It's not just a financial transaction, it's an emotionally draining marathon. So, to bring it all together, why does the housing market feel worse even though mortgage rates have fallen? It's a perfect storm. First, you have the lock-in effect, which is strangling housing supply as existing homeowners refuse to give up their ultra-low mortgage rates. Second, the slight dip in rates has unleashed a torrent of pent-up buyer demand. with everyone jumping back into the market at the same time. Third, home prices remain stubbornly high, meaning that even with a better rate, the overall affordability is still a massive challenge for the average person. And finally, the psychological burnout and renewed FOMO are creating a high-stress, hyper-competitive environment that's exhausting for buyers. It's the combination of all these factors that creates this paradox. The market isn't just about one number, it's a complex ecosystem. So if you're out there feeling frustrated, know that you're not alone and your feelings are completely valid. It's a tough market, and understanding these underlying forces is the first step to navigating it successfully. What can you do about it? Well, knowledge is power. The first step is to manage your expectations. Understand that this is a marathon, not a sprint. The days of lowball offers are, for the most part, gone for now. Be prepared for competition. This means having your finances in perfect order before you even start looking. Get fully pre-approved, not just pre-qualified. This shows sellers you are a serious and capable buyer. Second, be flexible. You may not get your perfect dream home in your ideal neighborhood on the first try. Consider expanding your search criteria. Look at different neighborhoods, or maybe consider a home that needs a little bit of work. Sometimes the best opportunities are the ones that others overlook. And most importantly, work with a great real estate professional who truly understands your local market dynamics. They can help you craft a competitive offer and guide you through the emotional ups and downs of the process. Don't let the frustration get the best of you. Stay persistent, stay informed, and be strategic. The right opportunity will come along. Thank you so much for watching. I hope this explanation helped clear up why the market feels the way it does right now. It's a confusing time, but we're here to help you make sense of it. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel for more insights into the housing market and personal finance. And I'd love to hear from you in the comments below. Are you currently house hunting? What has your experience been like? Let's share our stories and learn from each other. Thanks again for tuning in, and I'll see you in the next video.